What's up everyone, hope we're all well. In this complete beginners trading course, we're going to cover a complete A to Z from where trading started, what it is, how we can make money from it, and just give you guys an overall general understanding of what the hell is going on. I'm sure you've seen lots of stuff online about trading and you've probably tried making a start so far and everything is just way too confusing. So instead of deep diving in and jumping on the chart straight away, we're going to spend some time just covering what is trading, what does it mean, what is this chart, and what are all these candlesticks, stuff like that. So just take your time with this one. It's 90 minutes long. Feel free to go away and come back to it. You don't have to sit here for 90 minutes and watch everything. But this is going to be a complete starting from scratch guide to help you guys get to grips with what the hell is trading and what does it all mean and what is everything that's going on. So this isn't going to be super comprehensive, but this is necessary to understand before you get on with the other stuff. Once you're done with this video, check the link in the description and you can get started with a more intermediate guide of trading where we'll actually show you chart patterns and trading strategies and more specific stuff like that. But for now, let's actually understand what trading is and what the hell is going on. So grab a drink, get comfortable, and let's watch this 90-minute course. Lesson 1. What is Forex? This lesson will solidify your understanding of what the foreign exchange markets are, why they exist, and how we can make money from them. Forex is the same as foreign exchange, is the same as FX. You've probably seen this at some currency converting counter at an airport or on holiday. That's the exact same thing that we're talking about here when we talk about Forex trading. Where did it all begin? We're going to talk about the gold standard, otherwise known as the Bretton Woods Agreement, which was between 1944 and 1971. With this agreement, all major currencies were directly correlated to the US dollar, which was then directly backed by gold, okay? So the price of the dollar was directly related to the price of gold, and then all major currencies were directly related to the dollar. So in turn, all major currencies were directly related to the price of gold, essentially. This agreement then broke down, and in turn, currencies weren't backed by anything, floating freely, which would be a nightmare for international trade. This led to the need for the foreign exchange market to be created, a marketplace which determines the price of one currency against another. Think about it. How would you know how much your £100 of spending money is worth in euros, if not for an officially agreed value, okay? So put yourself at that cash converting desk at the airport and you've got 100 quid to spend on holiday, okay? Imagine now you have to barter every single time how much euros you should get for your £100, okay? It's going to be a nightmare. Then take that to international trade, okay? When there's deals being done every minute of every day, okay? Nightmare. Can't happen. So that's why the foreign exchange market exists, to determine how much one currency is related to another at an officially agreed value. This market was mainly traded by financial institutions and governments up until about 1990 onwards, when technology became more and more widespread, enabling public access to trade them too. The exchange rates of currencies fluctuates up and down each day in ways which can be accurately predicted with the correct models and strategies, which we're going to go over in this course. The buying and selling of these exchange rates to intentionally make a profit is known as Forex trading. Let's imagine you go on a 1-week holiday to Spain and you've got £500 of spending money. That £500 is converted into euros, and then after a week, whatever you've got left is converted back into Great British pounds. Let's say a week goes by and you haven't spent any money, okay? It was a really good all-inclusive, you didn't need to spend anything, so you've still got the full amount. On the 31st of July 2024, for example, £500 was equivalent to €593.54. On the 7th of August 2024, about a week later, that €593.54 was equivalent to £511.04, okay? So here you've got Euro GBP, which is the exchange rate between euros and Great British pounds. And you can see there from the table, on the 31st of July, the exchange rate was that much. And then on the 7th of August, the exchange rate was that much. So In a week, you've gone on holiday, you've came back, and now your £500 is now suddenly worth £511, okay? So after a week, your £500 has turned into £511 by doing nothing at all. But why? The value of one currency compared to another changes over time. The exchange rate of foreign currencies is known as Forex. Okay, so here's the chart which you commonly see that traders always put up. Here we're talking about the exchange rate of two currencies, okay? In this case, euros against the Great British pounds. Along the bottom axis is time. So all we're doing is looking at how the exchange rate of two currencies changes over time, okay? In Forex trading, we're doing this, but on a much more aggressive and purposeful scale. So we'd be looking to buy in a place like this and then sell at a place like this. So all you're doing is converting one currency into another, letting time pass when the value of it changes, and then convert it back, and you've made a profit intentionally. And there's plenty of strategies that you can learn, which we will teach you to do this purposefully and intentionally to make a profit in the same way. Lesson 2. How Forex works. This lesson will explain the logic behind how Forex works in a basic way which is easy for you to understand. So what is a Forex pair? Exchange rates work in twos. It's the comparison of one currency to another. This is known as a pair. Think of it as a ratio between one currency and another. So for example, you've got the pound US dollar, which is a ratio between the pound and the dollar. What makes a Forex pair move up and down? So if the pound is seen to be stronger than the dollar, then the pound US dollar will increase in value. And if the pound is seen to be weaker than the dollar, then the pound US dollar will decrease in value, okay? So it works like a ratio between the first currency and the second currency. The firstly named currency is known as the base, and the secondly named currency is known as the quote. So for example, again, we've got the pound US dollar. The pound here is the base, and the dollar is the quote. Don't worry about remembering definitions, okay? We're not in school, so you're not going to have an exam based on what's the quote and what's the base currency when you're trading. All the market cares about is the pair moving up or down, and have you bet that it's gone the right way? So all these terminologies and stuff, they're just sort of proper for you to learn, but you don't have to remember specific things like what does base and quote mean. So major pairs, minor pairs, and exotic pairs. The major pairs are the ones which include the dollar of the popular currencies. The minor pairs are the popular currencies which exclude the dollar. So for example, you've got the euro and you've got the pound, which are two very popular currencies. If you're trading euro GBP, that's going to be a minor pair because it doesn't include the dollar. However, it's still popularly traded. Then you've got exotic pairs. So you might have the Turkish lira against the Indian rupee, for example. They're two currencies which you can trade against one another, but it's going to be an exotic pair because they're non-popular currencies. So you could trade them, but there's going to be a lot lower volume through them because they're not popularly traded in retail. What does that mean? It means that they're going to be a lot more volatile and they're going to have a lot more spreads. So it's going to cost you a lot more to trade them, which is why people usually don't. There are exotic currency pairs which people are trading a lot nowadays. So we see the Singapore dollar come up a lot, which people trade. So you do have these exotic currencies which are sort of on the rise. And when there's a world event, for example, where it's quite obvious where one currency pair is going to go, it would be smart to trade them. So for example, recently the ruble has massively dropped in value, the Russian ruble. So you do see a lot of people trading an exotic currency when it's got a clear direction, okay? Similar with the Turkish lira. So it's not like you can't trade them, but mainly in retail trading, we stick to the major and minor pairs because they're a lot less volatile relatively, and the spreads are a lot lower. So it costs you less to actually trade them in the first place, meaning you get higher profit margins. So here's your 7 major pairs. You've got the pound US dollar, the euro US dollar, Aussie dollar, New Zealand dollar, dollar CAD, dollar Swiss, and dollar yen. Then you've got the 21 minor pairs. The way these minor pairs are made up is it's the counterparts of the currencies which are paired with the dollar of your major pairs pitted against one another here. So for example, top one pound US dollar, second one euro US dollar. If you pair the euro and the pound, euro GBP, you get euro GBP, which is a minor pair. So that's how we determine what the major pairs are and what the minor pairs are. It's the pairs pitted against the dollar, which are popular, so those 7 there. And then if you take the counterparts of those major pairs and pair them with each other, you get the 21 minor pair combinations there. Forex terminology. So a long position, aka buying, otherwise known as going long, okay? So when you're buying or going long, you're betting that the base currency will strengthen relative to the quote currency. So here with pound US dollar, if you're going long on the pound US dollar, you're betting that the pound is going to increase in value compared to the dollar. Also, you could be betting that the dollar is going to decrease in value compared to the pound, which would also cause pound US dollar to increase in value. So remember when I said think of these as a ratio of one against another. If the dollar is going down while the pound is staying the same, pound US dollar is going to increase in value. So by going long, you're also betting that the quote currency will weaken relative to the base currency. Either way, the stronger the base currency gets and the weaker the quote currency gets, the more the pair will increase in price. Short positions, aka selling or going short, you're betting that the base currency will weaken relative to the quote currency. So here you can see with the pound US dollar, if the pound decreases in value while the dollar stays the same, pound US dollar is going to decrease in value and you want to be going short. Or you're betting that the quote currency will strengthen relative to the base currency. So by going short, you could be betting that the dollar is going to increase in value while the pound stays the same. Either way, the weaker the base currency gets and the stronger the quote currency gets, the more the pair will decrease in price. So if you've got the pound going down in value and the dollar going up in value, as a whole, this ratio of pound US dollar is going to go down in price and you want to be selling. This was a lesson explaining the logic behind how Forex works, what Forex pairs are, and how they go up and down, which is easy to understand. Lesson 3. How does selling a Forex pair work? This lesson will explain the logic behind longing and shorting Forex pairs, otherwise known as buying and selling. We will explain the age-old beginner question that is, how can you sell something if you haven't even bought it yet, which is commonly asked in Forex trading. So a long position is betting that the base currency will strengthen relative to the quote currency. And short positions are betting that the base currency will weaken relative to the quote currency. Betting is the key word here. There's no actual exchange of currency when we trade. We're not buying or selling any assets. We're simply speculating the derivatives of those assets, similar to gambling. Now, that's a bit of a mouthful, but an analogy to explain that is that if we bet on Manchester United to win 3-0, we're speculating that the outcome will go a certain way. That doesn't mean we're buying any shares in Man United by doing this. We're just betting that one outcome is going to happen. So longing or buying. If we buy 1 unit of something and then sell that 1 unit of something, the total outcome is +1 minus 1 equals 0, which makes it a zero-sum game, or adding up to 0 in the end. If we buy that 1 unit of something for £100, then it goes up in value, and we sell that 1 unit of something for £150, we make £50 profit from the difference. All in all, we bought something and then sold that something, and now we have nothing, except for the £50 profit we made. In Forex, whenever we place a buy for 1 unit, we're in a contract to sell that 1 unit at some point in the future, whenever we close a position, which has to happen at some point. So this satisfies the parameters of a zero-sum game. So shorting or selling, if we sell 1 unit of something and then buy that 1 unit of something back, the total outcome is -1 + 1 equals 0, which makes it a zero-sum game, or adding up to 0 in the end. If we sell 1 unit of something for £150 and then it goes down in value and we buy that 1 unit of something back for £100, we make £50 profit from the difference. All in all, we bought something, we sold something, and now we have nothing, except for the £50 profit that we made. In Forex, whenever we place a sell for 1 unit, we're in a contract to buy that 1 unit back at some point in the future, which is whenever we close a position, which has to happen at some point. This satisfies the parameters of a zero-sum game. Now remember, we don't own anything anyway. We're just speculating or betting that price will move in a certain way. Think of this as borrowing 1 unit from someone, selling it, and then buying that 1 unit back from someone else to pay the lender. So let's go through a real life example to compare that. Let's say we borrow an item from someone and agree to give it back at some point. We then sell the item for £150. Then we buy the exact same item back on sale for £100. We then give the item back to the original lender. Now we have no items except for the £50 profit that we made. The same is true when selling a pair or shorting a pair in Forex. We don't own anything anyway, we're just betting that it's going to go down and then close a position after it's gone down in a profitable case. So you don't own anything when you're trading, you're just betting that things are going to move up or down. The way to think of shorting or selling, which is actually what happens, is you're in a contract to buy that unit back anyway, and it's a zero-sum game, so you can sell something before you've bought it. That example should sort of explain how it works in a way that makes sense, and hopefully we've covered the age-old question that is, how can you sell something if you haven't even bought it yet in Forex trading? Lesson 4, Forex Dictionary. This lesson will walk through the most common Forex terminology and explain each one clearly. Technical analysis, a type of financial analysis that uses patterns in visual market data to identify trends and make predictions, usually through the use of Japanese candlesticks. Fundamental analysis, a type of financial analysis that uses economic factors to make predictions on the market movements, such as news events, interest rates, inflation figures, GDP, employment rates, etc. Institutional/institutions. This is the likes of banks, Wall Street, government, pension funds, mutual funds, insurance companies, etc. These are the large corporations which have massive amounts of money to move the market with. Price action. The movement of price plotted over time. Price action forms the basis for all technical analysis. Don't let this fancy term confuse you, it literally just refers to the price movement as you see it visually on the charts conducted over time. Sentiment, your bias for the direction of a trend. Bullish, bearish, neutral. Bullish. If price is bullish, it means price is going up. If you are a bull or bullish, you think price is going up. Where that term comes from is how bulls attack. They start with their horns down, they lift their horns up to attack. Such is a bullish trend. Bearish. If price is bearish, it means price is going down. If you are a bear or bearish, you think price is going down. Where this phrase comes from is how bears attack. They come from above and they attack down below, as is a bearish trend. Balance. Balance is the money available in your account, not including open positions. Equity. Equity is your balance plus your open positions plus any broker credit or anything like that that you've got as extra on your account. So in this example, you can see the equity is a sum of the balance plus the open positions plus the credit on the account. Market execution. This is where you enter a trade at the current market price. Buy limits and sell limits. This is where you are looking to enter a trade once price comes back to a certain level. Buy stops and sell stops. This is when you're looking to enter a trade once it continues and passes a certain level. Stop loss. The point at which your trade becomes invalid and you cut your losses, exiting the position. This should always be predefined before you enter a trade. Reason being, you need to know how much you are risking on a trade by having a predefined stop loss and know the distance between your entry and a stop loss. There are traders who place positions without stop losses. It's very dangerous. The market moves suddenly and it could take you out and lose further than you intend to lose if you don't have a stop loss set. Plus, you don't actually know what lot size you need to place if you don't have a stop loss level, which we'll get into later. Take profit. The point at which your trade becomes successful and you take your money out of the markets, securing a win and closing the position. This doesn't always have to be predetermined. You can just open a position without a take profit level set and choose it later, but it's normally smarter to have an exit plan before you even enter the market. Risk to reward ratio. The size ratio of your take profit and stop loss. How much you stand to gain versus how much you stand to lose. For example, if you risk 1% per trade and your trade is free risk to reward, when you lose 1%, and when you win 3%. Here you can see visually, it's the size of the stop loss in comparison to the size of the take profit. Break even. Closing a trade for zero net profit. When a trade is running in profit, some traders use a tactic to set their stop loss to the entry point or break even point, making it a risk-free trade. In this scenario, the trade now has two options, either close at 0% or be a winning trade. This is usually denoted as SL to BE. Stacking or scaling in. This is where you increase the size of your exposure on a current open position by adding more positions. Usually this is done in the direction of a winning trade, but there are some trading strategies which incorporate adding more to a losing position. However, it's usually smarter to do this when you're already winning. Partial profits or scaling out. Decreasing the size of your position on a current open trade, usually to secure some profits by closing part of the trade out in profit. So here you can see we have a TP1, a TP2 and TP3. Within this trade, you'd be looking to close out partial profits at TP1, close out partial profits at TP2, and then leave the rest to run for TP3. In doing so, you can secure some profits even when your trade doesn't fully win all the way. Hedging. Opening a position in the opposite direction to an already open trade to reduce your total exposure to price changes. So for example, if you have a one lot buy and you have a one lot sell, no matter how the market moves, your buy position is making just as much as your sell position is losing, causing zero net profit, and vice versa. Equity drawdown. The amount a trade or trades is in a floating loss, usually measured as a percentage of your balance. For example, if you are holding a trade which is minus £100 and your balance is £1,000, this is 10% equity drawdown, 100 divided by 1,000. Balance drawdown. The amount of trade or trades in a consecutive losing streak, measured as a percentage against the original balance before the losing streak started. For example, you've taken 5 losses in a row, each losing £20 each, for a total of £100. Your balance was £1,000 before the first loss. This is 10% balance drawdown, 100 divided by 1,000. Floating profit. The amount a trade or trades is in a floating positive sum but hasn't yet been closed. Correlation. If two or more currency pairs are highly correlated, there's a strong relationship between the two of them. What happens to one of them is very likely to happen to the other. For example, the pound and the euro are very highly correlated. This is because they carry out a lot of similar economic activities which are tied to one another. So if something affects the pound, it usually affects the euro. And there's many examples like that within the Forex market. Confluence. A confluence is the junction of two rivers coming together, as you can see in the diagram. It's a commonly used term in the financial markets, used to describe multiple reasons aligning to reinforce the same suggested outcome, giving it a higher probability. Volatility. Moments where price is liable to change rapidly and unpredictably, especially during high-impact news events. Liquidity. So we'll talk here about liquidity in the markets. Liquidity refers to the ease in which a market can be traded without affecting its price. Everything which is bought needs a counterparty to sell it to, and vice versa. A market with lots of buyers and sellers at any given time is highly liquid because you'd be able to find a counterparty to buy or sell to quite easily. But if there are very few buyers and sellers at any given time, then it's illiquid. Major pairs are typically the most liquid. Minor pairs are still highly liquid, but not as much as major pairs. And exotic pairs or less traded pairs, markets will be less liquid. Now we'll talk about liquidity as seen on the charts. So, for institutional trades or large orders in the market to be put through successfully, they need to buy at points where there are lots of sellers and sell at points where there are lots of buyers. When you close a buy position, you're selling it back to the market. And when you close a sell position, you're providing a buy position back to the market. So, I know you're probably a beginner at this stage, but try and look at this chart. You can see at the high and the low points, price will often take out these levels and then reverse. This is because you would commonly place a stop loss above a level or below a level. The market is trying to seek your stop loss in order to provide liquidity to the higher institutional traders and the larger market orders. Volume. High volume means more buyers and sellers in the market at any given time. Low volume means fewer buyers and sellers in the markets at any given time. We need volume in the market to move price in our direction. If there's no volume, then the market will not move and we can't make any money. However, in instances of very high volume, such as a news event, price can be very volatile and too risky to trade, as price could move large amounts either way or in both ways. Slippage. Slippage is the difference between the expected price of your trade and the actual price at which it was executed or closed out. It often occurs during high volatility and can result in paying a higher or lower price than expected because your position did not close at the exact price of your stop loss or take profit. It can also happen when you're entering a position and you don't enter at the actual market price during your market execution, stop order, or limit order. Brokerage or a broker. A Forex brokerage is a financial services company that provides traders access to trading through trading platforms. Brokers earn their money through spreads, commissions, or both. They're sort of like the payment processors of the trading space, such as Visa or MasterCard are in the banking space. What I mean by that is they basically take a transaction fee for each trade that you place. Leverage. To leverage essentially means to borrow. This is the purchasing power you have in the market represented by a ratio. For example, a 1 to 10 leverage means £10 of purchasing power for every £1 in your balance. A 1 to 500 leverage means £500 of purchasing power for every £1 in your balance. With higher leverage, you have the ability to open more positions at the same time, or larger positions. With lower leverage, you're able to open fewer positions at the same time, or open smaller positions. Here is a diagram of leverage, as it is in engineering, where you have a fulcrum and a lever. The amount on the right is your balance, and the amount on the left is your leverage. The further away the fulcrum, the more leverage you have. In engineering, and without going too over the top, you would multiply the force by the distance. In this case, £500 times 1 meter gives you 500. Then on the right side of the fulcrum, £1 times 500 equals 500. Margin. A margin is a deposit amount which covers your leveraged positions. A portion of your funds are set aside each trade to ensure that you can cover the potential loss of the trade you've placed. This is not a cost or a transaction, more so it's a deposit. Margin call. When your open positions in drawdown exceed your total leverage capacity, your account has used up all of its leverage and you cannot open any more positions. If your drawdown gets worse, your open positions will start to close at a loss in order to maintain the leverage to be able to hold the rest of the positions open. A blown account. When your trading account balance reaches zero or near zero due to losses incurred from trading. Lot size. A lot is a standard unit which measures how big your position sizes are in trading. One lot, or a standard lot, is 100,000 units of the base currency. 0.1 lots, or a mini lot, is 10,000 units of the base currency. 0.01 lots, or a micro lot, is 1,000 units of the base currency. Pip, or pips, or pipettes. So a pip is percentage in point. Because a Forex pair is a ratio of one currency to another, it's technically unitless, meaning the units cancel each other out. So the change of this ratio is expressed as a percentage change. This is measured in pips. So, for example, things in the real world would usually have units such as 10 meters or 10 seconds or 10 kilograms. However, if you have one number divided by another number and they both have the same units, the units cancel each other out, and what you have is a ratio or a unitless number, which is the same in Forex. Therefore, we express changes in Forex pairs in pips, which means percentage in point. A pipette is the same as 0.1 pips. Pips are important to get your head around, but are super easy once you know how to. So we will begin doing a lesson on how these work soon with real life examples. Spread or spreads. First, we need to understand the ask and bid price definitions. Ask price is the price that you can buy for, and bid price is the price that you can sell for. These are not the same, there is a small difference. That difference is called the spread. Spreads, again, are important to get your head around, but super easy once you do. So we'll be doing a full lesson on how these work soon with real life examples. That concludes our lesson about the Forex dictionary. Hopefully that's walked through the most common terminologies and explained each one clearly to you. Pips and spreads we'll be going over in the next lessons to properly explain these to you, as they're hard to understand by just reading the definition. However, let's move on and clearly look at what are pips and what are spreads. Lesson 5. What are pips? This lesson will explain how to read and how to use pips within trading. Pips versus pipettes. 1 pip is the same as 10 pipettes or 10 ticks. 1 pipette is usually the last decimal place of a currency pair. Forex pairs are either 5 decimal places or 3 decimal places. Here you can see the pound US dollar, which is 5 decimal places, which is the same for most Forex pairs. Then you can see the pound JPY, which is 3 decimal places. This is true for all JPY pairs or yen pairs. The last decimal place of a Forex pair is the pipette, and the second to last decimal place of a Forex pair is the pip. So here you can see on pound US dollar, the final 2 decimal places are 8-1, which is 81 pipettes or 8.1 pips. Here you can see the final 2 decimal pairs of pound JPY, which is 2-6, so that's 26 pipettes or 2.6 pips. Here's an example of a pip count on the TradingView measure tool. So how you get this is by doing shift click and then moving your cursor on TradingView, and this will measure between one point and another on a trading chart. So here you can see we have 1.30100 and 1.30000. The distance between these is 100 pipettes or 10 pips. You can see on the TradingView measure tool that it tells you 10.0. So this TradingView measure tool measures in pips. Here's an example of a pip count on the TradingView position size tool. There you can see the stop level in ticks is 100 between the same points that we measured on the previous slide. This 100 pipettes is the same as 10 pips. However, here entering 100 is 100 ticks, which is 10 pips. So the TradingView position size tool measures in ticks, otherwise known as pipettes. If you were to enter 10 here, that's 10 ticks, which is just 1 pip. So be very careful not to mix up pips and ticks. Here you can see pound US dollar, and here's a breakdown of the price and what each unit refers to in pips. So the last decimal is 0.1 pips, otherwise known as a pipette or a tick. And then going along to the left, you've got 8 pips, 80 pips, 400 pips, 2,000 pips, 10,000 pips. Pips on commodities and indices. So commodities are things such as gold, silver and oil, and index funds are things such as the S&P 500, the US 30, the NAS 100, etc. Remember back to last lesson where we defined what a pip is. Because a Forex pair is a ratio of one currency to another, it's technically unitless, meaning the units cancel each other out. So the change of this ratio is expressed as a percentage change, which is measured in pips. Commodities and indices, however, they are not unitless. Commodities are naturally measured in dollars per ounce, and indices are naturally measured in US dollars, which are referred to as points when we're trading. However, we can still turn both into pips to make life easier when trading. Remember that on Forex pairs, the second to last decimal is a pip. On gold, the same is usually agreed upon. However, it differs from person to person, so always sense check this when using pip size tools with gold and other commodities. So here you can see 2296.28. The last decimal place will be 8 pipettes or 0.8 pips, and then the second decimal place is 2 pips. Pips on indices. Each dollar value move on index funds is referred to as a point. 1 point is usually agreed upon to be 10 pips. So again, this leaves us with the general rule that the second to last decimal is 1 pip. Here you can see the US 30, which is a price of $37,918.59. In this scenario, the final decimal place is 0.9 pips, the second decimal place is 5 pips, and then the dollar value is a multiple of 10 pips. So here we can see that the last decimal point is 9, which is 0.9 pips, and then you've got the 50 cents, which is 5 pips, and then you've got the $8, which is 80 pips or 8 points. You'll find that when using different tools and calculators which involve the use of pips, pipettes, points, ticks, whatever, there are lots of inconsistencies across different sources. Especially beware of the free tools used for commodities and indices. I have personally found that some of these are lazily programmed to just calculate based on the FX pip layouts, which doesn't carry nicely across onto other tradable assets. The best practice is to sense check first by entering your entry price and stop loss price into the calculator and seeing which pip value corresponds to the same amount for a particular pair. This was a lesson on pips, explaining what are pips, what are pipettes, what are ticks, and what are points, and how to read and use them in trading across various different tools. Hi everyone, in this video we're going to go over the Forex chart, what it is, how to read it, what everything means, what these candlesticks are and how to read them, and hopefully take you from being completely clueless to what you're looking at here to completely understanding what it is that's going on. So first of all, this is a chart, which means you've got an x-axis and a y-axis. In trading, the x-axis is time, so you've got what day it is and what time the candle's at. And then on the y-axis, you've got price. So here you can see 1.295, blah, 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 that's the price. So all that we're measuring is how the price changes over time. So in this case, we've got the pound US dollar, GBP USD, so Great British Pounds, United States dollar. What we're doing is we're measuring how the price of that fluctuates over time. We want to see how the Y value changes as time gets further on, okay? What Forex trading is basically taking advantage of the fact that price changes over time. And what we're basically doing is we're looking to, for example, buy when price is this much, and then we're going to close out our position and sell, we'll make that red, when price is this much, okay? So if we correspond that to some actual values on the chart here, imagine you bought when price was at this level, 1.29105, and then let's say you sold or closed your position when price was about there. So we'll say 1.29769. Don't let the numbers confuse you, right? You don't really need to be good with numbers to do this sort of stuff. You just you'll learn it over time, okay? So what we're doing is we're just taking advantage of the fact that price changes over time, and we're going to buy in certain areas and we're going to sell in certain areas, and this difference in price is what's making us money. Now, from the previous videos, you'll have been taught about bid and ask. So basically buy and sell. The price that we read here on TradingView is always the sell price. I'll explain to you visually here. So if we go to buy and sell buttons, and then we go to bid and ask, we'll show both of those. So you can see this is the sell price, the bid price, which is shown to us on the chart. And then we also have an ask price or a buy price as well. So you see on TradingView, you got these two buttons up here that I turn off. So you've got 1.29522 here, which is your bid price. And then you've got 1.29702 here, which is your ask or your buy price. You don't need to remember ask and bid. You just think about them as sell and buy, basically. What this means is that if I want to get in a sell position right now, this is the price that I'll be selling at, okay? But if I want to place a buy position, my buy position will actually be taken at this price from this blue line here. As we've gone over in the previous videos, this difference in price is called your spread, okay? The difference between the bid and ask price. Basically what you need to know is that if you were to just place a sell right now and then close it out, so aka buy it back, that's not break even, that's not zero. There's a difference in price. If you're to just enter into the market right now, you've already been charged a spread. The spread is the difference here. You can see it optically, the difference between here and here. Now, the spread isn't usually this high. It's just because I'm filming this video on a Sunday when the market's closed. If you're trading in the London session or the New York session when there's decent volume, your spread's going to be pretty minimal. It's just when we're out of hours or in times where there's not much volume in the market, the spread increases. Now, the way to think about spread is it's sort of like a transaction fee. So like I've said, if you were to just place a buy position right now and then you want to close it out straight away, you're taking a loss due to the spread. You're not closing out at zero. This is sort of how the brokers make their money, right? Think of it like a card payment processing company, Visa, okay? If you own a bank or you've got a bank account, let's say you've got a bank account, right? And you've got your card or contactless, and you tap your card to spend some money. That payment processor takes a small percentage of that transaction, and that's their transaction fee. Well, the same is true for brokers and spread, okay? It's not free to trade in most cases. They're going to take that spread. So that's what this is. We'll go deeper in that later down the line. Don't really worry too much about that now. But all you need to know is that the level of price that is shown to you here is the sell price. Okay, so now we'll go into candlesticks and what these sort of little things are that we're looking at. First of all, I'm going to switch to a line chart like this. This is what most people think of and what most people are used to when we think about a chart, is it's a line that varies in Y value as the X value continues over to the right. It's the same as what we're doing with trading. However, this doesn't give you enough information in order to trade with. It gives you some information. You can clearly see where the highs and the lows and the highs and the lows are, and you can kind of tell that this graph is going down on a downtrend. But in terms of each individual data point, you don't get anything. You just get like the average price during that time period, okay? Whereas if we switch to something like this, and we have these Japanese candlesticks, these tell you a lot more information, and we'll break down right now what these mean, because they might look confusing at first, but they're super easy to understand. So don't let it get to your head that you don't know what this means right now. Let's break them down right now. Okay, so let's dive into candlesticks. We'll break down the anatomy of a candlestick and explain exactly what it means. Okay, so I'm going to pick on one of these candles right now. Let's choose this one here, okay? This candlestick. So I'm going to represent it, okay? So let's imagine, first of all, run the 1 hour time frame. So this is 1 hour's worth of price change represented within one bar or one candlestick. So let's take this level and we'll say that on the hour, this is where price opened. So this is the opening price, okay? Just that there. Then what happened is price from the opening price went all the way down here. See this? All the way down to the bottom of that wick. That's the lowest point that it went to. Then within the same hour, price went all the way up here. You see, in line with that wick there. And then imagine this is 1 o'clock on Friday. Friday the 25th October, 1 o'clock. That's where it started. All of this current price action is during the hour. And then come 2 o'clock, price ended up there at the top of the body. So let's draw that here. So that is where price then closed. So what we have is something that looks like this. Okay, so that's where it opened at the start of the hour. This is where it closed at the end of the hour. And then we had this, which was the low, the lowest that price went to inside that hour. And then this was the high, the highest point that price went to within the hour. The way that we show this within a candlestick is we connect the open price to the close price like that with a candlestick, okay? So what it looks like on a chart is you have the low connected to the high, and you have your candle body based on the open and the close, okay? So let's line that up. There's the body, there's the body, there's roughly the high, and there's roughly the low. So if we take this away, you'll see there that we've just represented this candlestick based on how it's broken down. So here's the open, here's the close, here's the high, here's the low. The candle's green, so the candle body's green in my case, because it closed higher than it opened, okay? So it's going up. This has gone up in price during the hour. Let's take a different candle now, and we'll do a bearish candle. So this was a bullish candle, meaning it's gone up. Let's do a bearish candlestick example now. Okay, so completely different. Let's pick this candlestick now. Okay, this big red one. So similarly, price opened here, like that. And then from the open, price went all the way up here. Price went all the way down there. And then it closed there, just like that. Okay. Oh, I've got rid of my arrow. Let's do that again. So we started here on the open. Price went up here. Then price went down there. And then price slightly retraced, ever so slightly there. And that's where it closed. And then you have the close here, just like that. So again, this is the open. This was the high. This was the low, which was very near the close, and then this was the close. So then what you have, if we draw this with a candlestick, from this open to this low, like that, let's make it red, and then all the way from the high to the low point, that's your wick. So it looks like this on the candle. Obviously, you can't see this line through the body. So let me draw that a little bit more properly. So it's from the body to the maximum point, and then it's from the body to the low point. Small little wick there like that. There you go. So that's this candlestick represented with what it means. The open, the high, the low, the close. The body's red in this example because the closing price is a lot lower than the opening price, okay? So there you go, that's the candlestick, and that's how to read these candlesticks. So I'm not going to go too deep into what these candlesticks mean and how to read them right now. I'm just going to explain to you how they work and what they're sort of made up of. But later on, we're going to explain sort of the significance of them, what you need to be looking out for when you're looking at candlesticks and stuff like that. For now, all I'll say is when you've got a bigger body like this, price is more bullish than if it was smaller. And if you've got big wicks like this, what you can sort of imagine is that price was at this level when it opened. You had price come all the way up here, then pull back. Then you had price come all the way up here, then come back. Up and back, up and back, up and back. This is resistance, okay? Price is trying to push higher and it fails to. Pushes higher, fails to. Pushes higher, fails to. So you can see just off the offset, there's a lot of resistance here, and these buyers are turning into sellers, okay? So you can literally see that happening right now through just looking at candlesticks. So that's why we use a candlestick and not a line. Okay, so that was looking at the 1 hour time frame. So each of these bars represents 1 hour's worth of price. Then if we go into the 5 minute, you can see that each of these candlesticks represents 5 minutes worth of price. So if we start here, Friday the 25th of October, 4 p.m. Next candlestick, 5 past. Next candlestick, 10 past. Next candlestick, quarter past. You get the idea. If we then go up to the daily time frame, what we're looking at here now is that each candlestick represents 1 day's worth of price. If we go to the weekly, same thing. Each of these bars is 1 week's worth of price pushed into 1 bar of data, and we can see where the week opened, the low of the week, the high of the week, and the close of the week. I'll show this to you now on the daily. So if we pick on this candlestick, okay, the 1st of October, let's draw ourselves a box around this, just like that. I'll mark out the high, the open, the close, and the low, okay? So obviously they're not going to be pinpoint exact because I'm looking at this from the daily perspective. So let me just line these up a little bit better. There we go, that's as best as we can do. So we're looking here at the 1st of October, Tuesday, okay? So let's zoom in on the lower time frames and sort of see how that daily candlestick is made up from the 1 hour candles. Okay, so something to note here, the Forex market is open 24 hours a day, 5 days a week. That's sort of like the simplistic way that we talk about it because it's open from Monday to Friday. However, depending on what time zone you're in, it's not going to be from midnight to midnight, okay? In the UK, which is where I'm based, or where I'm from at least, it opens at 10 p.m. So you can see here, Monday the 30th of September, 10 p.m., that's where the market opens. And then on Tuesday, 10 p.m., that's where the market closes, okay? So that's Tuesday's worth of price. Even though it opened on Monday at 10 p.m., this is what we call Tuesday in terms of trading. It's not really that much important to think about. No one's actually really trading at 10 p.m. on Monday, calling it Tuesday, okay? The London session will open around about 7 a.m., 8 a.m., depending on if it's GMT or BST. But yeah, the market actually opens at 10 p.m. So you'll see a lot of people saying trading starts on Sunday, 10 p.m. That's when Monday's price starts, basically. So we can consolidate this box to 10 p.m. to 10 p.m. and that's the day's worth of action. So you'll see here, Tuesday open, was here, where this line was. The high of the day was here, where we drew this line. The low of the day was here, where we drew this line. Price came up, and then it closed out here again, Tuesday to Tuesday. So if we plot our candle body, again, remember, we opened here, came up here to the high, came all the way down here to the low, and then we came up and price closed here once again. So now, what we have is this daily, let me grip that box, this daily body, which is red, of course, because price closed lower. And then we have the wicks, which are from the body to the high and from the body to the low, just like that. So if we take this candlestick out like this, then you'll see when we go on the daily, that's a little bit thin because it was just over 1 day, but there you can see that's exactly, clear these levels out, that's exactly it's not letting me move it in between for some reason. Try again. Let me grab it. It's not letting me grab it, but you get the picture. From here to here, and then from here to here, they're the wicks. And this is the candle body of this 1 day's worth of price. And we can see where it opened, the maximum, the minimum, and then the close. So then it doesn't really matter what time frame you're looking at. That stays the same. If you're on the daily, we're looking at 1 day's worth of price within each of these candlesticks. We then zoom in and you can see how price is fractal. We're still looking at the same graph. It's just that each data point that we select is based on what time frame that we're looking at. So here, each candlestick is 4 hours worth of price. Here it's 1 hour's worth of price. Even on here, here's 1 minute worth of price, okay? The levels are still the same. It's just you choosing how much data to show in each candlestick. So you get a lot more detail in the 1 minute, because obviously each of these is 1 minute worth of data, but there's also a lot of noise. You can't really understand that much on the 1 minute compared to if you're looking at the daily, each candlestick here has a lot more conviction because there's more data available in one candlestick, if that sort of makes sense to you right now. Now, one thing to understand, okay, you remember the 4 points of the candlestick, the open, the close, the high, and the low. When you're looking at price, live price, you'll have a tick candle, which is the current most present candle right now. You can't see it here because, again, I'm recording this on a Sunday when the market's closed, but you'll see this candle flickering. So let's pretend this is the live price now. You'll see this candlestick flickering and moving. And a lot of beginner traders get scared off this recent candle, or they'll take this recent candle into what the market's doing right now. You need to ignore the tick candle, okay? I'm not going to go too much into detail, but remember that a candlestick has 4 points: open, close, high, low. This current tick candle hasn't closed, so it hasn't given you enough data to be able to make a clear, informed decision. This candlestick right now, again, pretend this is the tick candle, it might look like that right now, but then imagine it takes a huge dump off to the low, okay? And you're there thinking, oh, price is dropping, and you're taking this candlestick as if it's something like this, but it's not, because price hasn't closed yet. So don't read this tick candle like the end of it is where the candle closes, because the close isn't. Within that same period, so in this case the daily, price could come all the way back up here and form a candle like that, something that would look like this green candlestick. So until you have that close, this tick candle doesn't really give you any information, or it misleads you in a way. So the only candles that you should consider are the ones on the left. The one that's currently open, which we call the tick candle, isn't giving you enough information to use it properly. So just ignore the tick candle. Okay, so that should be a complete rundown of how to read the Forex chart at a beginner level. So I'll do a quick recap. We've got the x-axis, which is time. We've got the y-axis, which is price. Then we have candlesticks, which are open, close, high, and low. The body is where price opened and where price closed. The wicks are the difference between the high and the open, and the low and the close, represented in a wick. That's why we call them candlesticks, because you can sort of see this and see how it resembles a candlestick with the wick. And then we've got these time frames that we can choose to view price between. And if we're on the daily, one of these candlesticks represents a day's worth of price. Now remember, if you're in the UK, it's from 10 p.m. to 10 p.m. The price which is shown to us here is the sell price. So if we're looking for a sell, this is the price that we're selling from. But if we're looking for a buy, remember there's a spread. So price isn't actually this. If we're looking to buy, this is just the sell price. The way you can see the buy price is by looking on the quotes tab on your MetaTrader, or you can turn on the buy or sell buttons on TradingView, but I'd probably just use your MetaTrader so you can get the exact price on your account on your broker. In our next lessons, we're going to go over how to use these candlesticks and different types of candlesticks and what they mean in different areas on the chart and stuff like that. But for now, hopefully that explains the anatomy of each candlestick, how to read these charts, how to use the time frames, and you're going to be feeling a lot more comfortable about learning Forex at this stage now. Lesson 7, spreads. This lesson will explain what spreads are, how to find them, and how to apply them in Forex trading. The definition of spreads. So a spread is the difference between the bid and ask price of a currency pair. The difference between the buying price and the selling price, basically. It essentially represents the cost of trading that pair at that time. How to find the spread. So the quotes tab on your MetaTrader account will show you the current spreads quotes for each pair. If you have a look at the visual on the right, you'll see what you see on the quotes tab on MetaTrader, and underneath each currency pair it will say the spread when you go in the advanced view. The spreads will fluctuate within a range depending on the time of day, liquidity in the market and the current volatility. High volume pairs have lower spreads and low volume pairs have higher spreads. How are spreads affected? So during peak trading hours, such as the overlap between London and New York session, spreads will be at their lowest due to a large amount of volume in the markets. During low volume trading hours, such as between New York session close and the Asian session open, spreads will be at their highest due to a low amount of volume in the markets. News spreads. In high impact news events, large changes in market prices occur within a short period of time, leading to high volatility. This higher volatility means prices can change drastically within milliseconds, and brokers may have trouble matching buy and sell orders accurately. As a result, brokers will widen their spreads drastically too to manage the added risk associated with trading during these unpredictable large movements, protecting themselves against potential losses. As a beginner, it seems exciting to gamble on news events due to the large movements in price. However, in reality, this unpredictability, higher volatility, and higher spreads results in a lower probability setup, and we're better off just trading price during more predictable and more desirable trading conditions. With spreads, always think of the worst case scenario as they work against us. On the quotes tab of your MT4 or MT5, if the spreads on your chosen pair are flickering between 8 and 10, assume the spread will be 10. Now, spreads are shown in ticks, not pips. So don't worry, that's not a 10 pip difference, that's a 10 tick difference, which is 1 pip if you remember back to last lesson. How to apply spreads. Remember that when you go long, you buy into the market and sell out of the market. When you go short, you sell into the market and buy out of the market. In buying, spreads are applied to your entry price, but your stop loss and take profit are unaffected, as those are selling out of the market. In selling, your entry is unaffected as you sell into the market, but then spreads are applied to your stop loss and take profits as that is you buying out of the market. So when you're buying, your spreads are on the entry, and when you're selling, your spreads are on your exits. So here's a spreads example with going long. At this time, the highest spread quoted for pound US dollar is 2 ticks, which you can see on your MetaTrader quotes tab, GBP USD spread 2. Now, because we're going long or buying, let's have a look at a buy position on the chart there. And remember, when you're buying, your spreads are on your entry. Take a look at the long position as plotted on TradingView. There we have an entry, a TP, and a stop loss. We're buying in, so we have to add our spreads onto our entry. Our stop loss and our take profit remain unaffected. As a result, spreads lower the actual RR made on each of your trades due to a difference in the execution price, stop loss or take profits. In this example, it's the execution price which is different. So if you take a look at the position again, you'll see that we've added a spread onto the entry price. As a result, that makes our TP slightly lower and it makes our SL slightly higher. So the risk to reward has lowered as a result. Let's take a look at another example, which is a short in this case. We're looking to short the Aussie dollar Swiss franc. At this time, the highest spread quoted for Aussie Swiss is 5 ticks. So if you take a look at the meta quotes tab there on the quotes, you will see spread is 5 on Aussie Swiss. Now look at the sell position as plotted on TradingView. So here are the original levels for entry, stop loss and take profit. Now remember that when we're selling into the market, our entry price is unaffected because that is the given sell price. However, when we want to exit the market, we have to buy back into the market. So our stop loss and our take profit levels are going to be affected. As a result, spreads lower the actual RR made on each of your trades due to the difference in execution price, stop loss or take profits. Here, our stop loss and take profits are affected because we're selling into the market and buying out of the market. So we have to go with the buy price to get out. We do that by adding our spreads on. So if you take a look at the levels on the axis, you'll see that we've added 5 ticks onto the stop loss and we've added 5 ticks onto the take profit. Now remember as well, if we're looking to go stop loss to break even, we'll also have to apply that to our entry price when we're putting a stop loss as entry, because again, we're buying out of the market there. So you can see the risk to reward. If we go back and then forward, you can see the stop loss has increased in size and the take profit has lowered in size, resulting in a lower RR. Now let's look at how the position size changes as a whole. So on the left, you can see the original stop loss size in ticks, and on the right, you can see the altered stop loss price after we've applied our spreads. Now, this goes for both buy positions and sell positions. You're either going to add your spreads onto your entry, or you're going to add your spreads onto your stop level, one or the other. So remember to apply the spreads to your overall position size when calculating your lot sizes. If your stop loss size changes, your lot size needs to change per a given percentage risk per trade calculation. We've not covered that yet, so don't worry too much about it. We'll go over position size calculations later on. With a slightly larger stop loss size, your lot size per trade needs to be slightly smaller than originally intended to in order to risk the same amount. Forgetting to apply your spreads will result in slightly over-risking on each trade, getting stopped out unnecessarily, not getting tagged into limit orders properly, and even your take profits being missed due to spreads. That concludes our lesson on spreads. That should explain what spreads are, how to find them, and how to apply them in your Forex trading. Lesson 8, the trading journey. While everyone's trading journey is different, this lesson will explain the roadmap that we suggest to becoming a consistently profitable full-time trader. First of all, just learn the basics. Don't FOMO into trading just yet, which is the fear of missing out. Stay with me as we cover the basics that you need to know before you even start. I suggest getting a notepad and pen and treating this like a sport which you want to become one of the best athletes at. It requires the same discipline if you want to be the best. We've already covered an entry-level bit of ground. Soon we'll be hopping on the charts. Be patient and don't cut out any corners, otherwise it will cost you. TradingView. TradingView is where you should conduct your technical analysis, which is marking up the charts. Use it to follow along with this course and manage all of your chart-based activities. There is a free version that you can start with while you follow along with all the entry-level basics. Soon we'll have a lesson about how to use TradingView to full effect. Demo accounts. Demo accounts are used for trading with paper money instead of live capital. They allow you to practice trading as a beginner on MT4 and MT5 without actually losing money when you lose. As a beginner, you will inevitably make beginner mistakes, as with anything. Even if it's just misclicking a button on the app, it can cost you considerably. So it's best to familiarize yourself with the act of trading and practice everything on demo as a new trader. Don't get ahead of yourself just yet. Backtesting. This is the most important aspect of becoming a trader. Backtesting is practicing your trading strategy on previous price action. If you're practicing with live price, you have to wait for it to play out in order to see the outcome. But with backtesting, the data of the outcome is there ready for you instantly. So you can learn at much more rapid speeds with backtesting than you can with forward testing. Backtesting, if we compare into the analogy of treating it like a sport, is basically like turning up to practice, okay? The more you turn up to practice, the better you're going to perform in the real games. Forward testing. Once you believe you have nailed something down with backtesting, you can start forward testing it, trading live price on a demo account. With backtesting, it's easy to say you would have done something, but you don't quite have the pressure element on you like you do with live trading, nor the patience element of having to wait for certain events to happen before you place the trade. Due to the waiting element, you can't cover as much ground with forward testing as you can with backtesting, like we said before. Live accounts. Once you've had around 2 to 3 consistently profitable months on your demo account, forward testing your strategy, now it's time to risk a small amount of live capital, which you can afford to lose, on a live account. This is like going from playing poker with Monopoly money to staking your actual money on the line. You'll feel the psychological shift immediately, and now you need to learn to handle the extra emotional effects when trading while staying cool and sticking to your plan. So now you're comfortable with trading a small amount of live capital, and now you're ready for the next level. Trading with a larger account balance will now bring the psychological elements up a notch. Still only trade what you can afford to lose, and you should only be trading with 1 to 2% risk per trade anyway, with a risk management plan in place, but still trade responsibly. At this stage, you're still not trading to make money, you're just trading to learn the craft and make percentage returns. Funded accounts. So at this point, you've been trading with a relatively significant live account size and managed to be consistently profitable for 2 to 3 months of trading again, following your trading plan correctly and comfortable with executing your trades, handling the emotions of winning and losing streaks properly. Now you're ready to trade on funded accounts, paying an upfront fee in order to trade with a larger account balance using prop firm capital. Treat this serious and with proper intentions, and you can be trading on funded accounts successfully within 6 to 12 months. Scaling your capital. So you follow our guides on trading funded accounts properly, and you're now receiving funded account payout withdrawals consistently and looking to increase your trading capital. Scaling your capital consists of allocating some of that payout money into building your own personal funds in a live account and managing multiple prop firm accounts simultaneously, getting max allocation from the trusted prop firms, plus other means of capital raising, which you'll go into later. 5% profit per month on $1 million of funding is $50,000 per month. This is why you have to look at trading in terms of percentages. Even at the start, when you're trading on demo accounts and small live capital, just understand the journey that you'll take as a trader. If you can make 5% per month on a $1,000 account, you can make 5% per month on a $1 million account. You just need to follow the journey and trust the process. Lesson 9, Unlearning. This lesson is about the concept of unlearning and explaining the non-linear nature behind learning how to trade. Previous knowledge. Forget everything that you thought you knew about trading prior to this course. Your progress will be much more effective by just applying what you learn in this course and not trying to combine it with things that you might have seen in free YouTube videos or social media clips about trading from other people. Trading is a non-linear discipline, meaning it doesn't follow a one after the other style set of steps. Something you learn from someone else may not be true with our approach. Have a blank canvas approach to this course. Trading is not MMA. MMA, otherwise known as mixed martial arts, consists of boxing, Muay Thai, kickboxing, jiu-jitsu, wrestling, judo, karate, etc., etc. In MMA, It doesn't hurt to add other weapons to your arsenal and combine them into your fighting style. With creating your trading plan, combining too many elements from different sources can be hurtful as they may not be compatible together. Unlearn any prior concepts you have seen about trading and build a fresh, new, profitable trading approach with us. If you have learned something from someone else, which may be useful in our strategies, we will teach you them. Aside from that, just forget everything that you ever thought you knew about trading and let's relearn it all now properly. Lesson 10. Types of trading. This lesson will teach you about all the different classes of trading and how they differ. Within this course, we'll teach you strategies for every single type of trading so you can choose which type or types work best for you. Swing trading. Swing trading involves placing trades with the intention of holding them over several days, weeks, or even months in some cases. Usually, this is conducted on the higher time frames, such as the 4-hour, the daily, the weekly, or the monthly. Day trading. Day trading involves placing trades with the intention of opening and closing them within the same day, but sometimes you may hold them over multiple days. Depending on the strategy, day trading is usually conducted on the time frames such as the 5-minute, the 15-minute, the 30-minute, and the 1 hour. Intraday trading. Intraday trading is pretty similar to day trading, except it's conducted on even lower time frames, aiming to open and close trades within just a few hours, usually within the same trading session. For example, open and close within London session. This is usually conducted on time frames such as the 1 minute and the 5 minute. Some traders may even go down to the seconds time frames. Scalping. Extremely short-term trading focused on profiting from rapid, tiny moves in the markets. Usually relies upon having a large amount of trades with high percentage win rates but low profits per each trade. Usually conducted on the seconds time frames as well as 1 minute and maybe the 5 minute. Discretionary trading. Discretionary trading, commonly just known as manual trading, involves the buying and selling of trading positions without any element of automation. Traders rely on proper judgment, experience, and intuition to follow their trading plan, knowing when to trade and when not to trade. Algorithmic trading, otherwise known as algo trading, involves the buying and selling of positions based on a predetermined set of rules which have been coded into a software to execute hands-free. Institutional traders are among the primary users of algorithmic trading due to its efficiency and precision. However, beware of algo trading as the retail trading space is flooded with algo strategies which simply don't work. Quantitative trading. Quantitative trading, otherwise known as quant trading, involves data-driven trading methods using mathematical and statistical models to find trading opportunities. Quant strategies are usually based upon a large amount of historical data, modeling patterns which are likely to occur again in the future to generate profits. Commonly coded into algos due to their rule-based nature and sensitivity to exact price levels. Fundamental trading involves the trading of currencies based upon macroeconomic data such as bond prices and government policies. A focus on long-term value, pitting one currency's strength against another's weakness due to fundamentals rather than technical analysis. Lesson 11. When to trade. This lesson will teach you the timings of the financial markets, including the opening times, closing times, and the market session times. First of all, what is UTC? So UTC stands for the Universal Time Coordinate, and it's a reference time frame that we can all agree on around the world so that we're working on the same time axis. As you can see from the map here, the UTC line goes all the way through the United Kingdom. Reason being, when Great Britain conquered the world and built the biggest empire, we created the map. So we just decided, let's put ourselves in the middle. We'll call that 0 time. Everything to the left is negative and everything to the right is positive. So whenever you're referring to time frames with other people around the world, they will say, I'm 7 hours ahead or I'm 7 hours behind, referring from one country to another. In the financial markets, we refer to UTC, which is the Universal Time Coordinate. GMT which is the British time throughout the winter, Greenwich Mean Time, is 0 UTC. And whenever we have our daylight savings, so when time moves by an hour and turns to British summertime, that's UTC plus 1. So universal time coordinate remains the same all year round, regardless of daylight savings, and it's a reference time frame that other countries use to refer to a sort of central axis of time. Okay, and that's what we'll go through, and that's what we base everything off in trading. Forex market times. We say the Forex markets are open 24/5, meaning 24 hours a day, 5 days a week. But that doesn't necessarily mean midnight to midnight, depending on your time zone. In the UK, which is UTC plus 0, the market opens at Sunday 10 p.m. and closes for the weekend at Friday 10 p.m. In New York, which is UTC minus 5, the market opens on Monday at 3 a.m. and closes for the weekend on Saturdays at 3 a.m. The regular Forex market hours consist of 4 separate 9-hour sessions: the London session, the New York session, the Tokyo session, and the Sydney session. The Tokyo session and Sydney session overlap is commonly grouped as one to form the Asian session, leaving us with the London session, the New York session, and the Asian session. Now, when it comes to actually trading, lots of countries have different daylight savings throughout the year at different times. So you do have to adjust your approach a little bit by plus or minus 1 hour from these times at certain times of the year. But in order to keep it simple for the purpose of this video course, we're just going to keep the times as they are like this, which is what they are for the majority of the year. But just to note, when the daylight savings go plus or minus 1 hour, all the different countries have that at different times, but we'll get into that later on in the course when you go to the intermediate section and the advanced sections, as well as following our guidance as we are trading inside the Discord community. In the UK, or UTC time, which is UTC plus 0, the Asian session is between midnight and 5 a.m. London session is from 8 a.m. to 5 p.m. and the New York session is from 1 p.m. to 10 p.m. So in the UK, the London session is 8 a.m. to 5 p.m. This is typically when the institutional traders will be sat down on their desk and conducting their work for the day at their institutions. So it's when the most volume is traded throughout the UK within the UK working hours. In New York time, which is UTC minus 5, the Asian session is from 7 p.m. to midnight, the London session is 3 a.m. to midday, and the New York session is 8 a.m. to 5 p.m. If you'll notice anything, you'll notice that the New York session in local time is the same as the London session in local time, which was 8 a.m. to 5 p.m. Same principle applies. This is when the institutional traders within New York will be sat at their desk trading institutional volume. Equities market hours. So equities is stuff like stocks, shares, indices. The way to remember this is if you're trading those, you're trading an equity stake of that company in principle. So like a percentage share of the company. Indices include the S&P 500, the NAS 100, the US 30, the UK 100, and other world indices. World indices impact world currencies. If you don't know what indices are, they're like a group of equity shares bundled as one. So the S&P 500, which is the Standard & Poor's 500, is the top 500 companies in America basketed together to trade as one asset. The UK 100, same principle. The top 100 companies in the UK group together to form one index, which is what index funds are, otherwise known as indices. In the UK time, which is UTC plus 0, the equity market hours are from 2:30 to 9 p.m. In New York time, which is UTC minus 5, the equities market hours are from 9:30 a.m. to 4 p.m. So again, a similar time reference that the Wall Street guys will be sat at their desk trading equities. It's an important time frame to understand, and to understand that it's different from just the whole New York session, because A lot of news will come out at that 9:30 New York time, or when that opening bell happens for the equities market, impacts will be had on the New York session and just the Forex markets in general at that time. So it's important to consider the equities market hours as well as the New York session hours. Cryptocurrency market hours. The crypto markets are open 24/7, including on the weekends. But typically, crypto will still move more during the weekdays, as this is still when the institutions are sat at their desk trading their positions. So that's when the largest amount of volume is pumped into the markets. Daylight saving times. Countries around the world all observe daylight saving times, shortened down to DST, on different days to one another. So this can be confusing when daylight saving times occurs. In the UK, the clocks go forward plus 1 hour at 1 a.m. on the last Sunday in March, becoming BST, which is British Summer Time, and that is UTC plus 1. Then the clocks go back 1 hour at 2 a.m. on the last Sunday in October, becoming GMT, otherwise known as Greenwich Mean Time, which is UTC plus 0. In USA, the clocks go forward plus 1 hour on the second Sunday in March, and the clocks go back an hour on the first Sunday in November, both taking place at 2 a.m. local time. Don't worry about remembering that, okay? Just be aware that whenever the clocks change in your country, it won't be necessarily in sync with all the other countries. It'll be somewhat around the same time, usually in the same 1 week or 2 weeks. So there's only really like a 2 weeks max overlap that you really have to consider this. But whenever you do have a daylight savings times, just check online what the other market session hours are. That's just all I'll say. You don't have to deep it too much, but it's something that you need to take into consideration. Volume and spreads. In principle, the more volume in the markets, the tighter the spreads and the less slippage you'll experience. Overlaps have the most volume. A pair like Aussie dollar JPY will experience a higher trading volume when both the Sydney and the Tokyo sessions are open. Aussie dollar being local to Sydney and the Japanese yen being local to Tokyo. Pound US dollar will experience a higher trading volume when both the London session and the New York sessions are open. So you also have to consider where the currency's country is in the world, and then what time of day the people of that country are going to be sat at the institutional desks trading that pair. That's not to say that people in London and New York aren't trading Aussie dollar JPY, and that's not to say that people in Sydney and Tokyo aren't trading the pound US dollar. But you have to think these people and these companies are usually trading in their local currency whenever they're conducting business or doing international trade, but we'll get into all that later down the line. For now, just think of that concept. All of these market session times are freely available online, and we have some very useful indicators which will plot them on your TradingView charts with ranges around each session. So you could be on alert whenever it's a new session. You do want to remember whenever these times are, but don't worry, it's nothing complicated. It's something that you get used to over time. Hopefully, this lesson has taught you about the timings of the financial markets, when they open, when they close, and when the best times to trade are. Lesson 12, Workspace, Setup and Tech. This lesson will teach you about the only hardwares and softwares that you really need for trading and everything else which can improve your trading journey. Workspace. Here are two important metaphysical principles for life. Number one, you're a product of your environment. And number two, how you do anything is how you do everything. With these two things in mind, therefore, it's important to keep your workspace clean and organized so that your trading will reflect the same. If you want to conquer the Forex markets, at least start by conquering your desk first, and then you can move on to some bigger challenges. Setup. You don't need to have 4 computer screens and a £10,000 PC with a gaming chair in order to be a trader. Yes, the bigger the screen, the better, as you can see more of the chart at once, but it's not a necessity, just a nicety. If you can't get a PC or a laptop, You could just use your phone for TradingView in theory, but I do recommend a desktop. £300 to £400 for an 8GB RAM laptop is all that you really need. And also get a mouse, it makes everything so much easier. Tech. TradingView. This is what we use to analyze the charts. There is a free version that you can start with to just look at the charts, but once you start backtesting, get the Essentials plan at least for bar replay mode, which we'll go over later. Make an account and log in on both your desktop and your phone to synchronize your charts. What that's going to do is whenever you change something on your desktop, it's going to show the same on your phone. And whenever you make a change on your phone, it's going to show the same on your desktop. MetaTrader 4 or MetaTrader 5 for executing your trades on. So we mark up our charts on TradingView, but for actually placing the trades, we use MetaTrader, which you can just do on your phone. Don't use the desktop version, it's way too complicated, just use it on your phone. If you're still a beginner, just sign up to a demo account with one of our recommended brokers and then log into this on your MetaTrader app. Currently, if you're in the United States, MetaTrader isn't available anymore, so you have to use CTrader or DXTrade, which are just as good and serve the same purpose. You're going to want a high quality trading brokerage, otherwise known as a broker. They have mobile apps and client portal websites. Just look into the ones that we recommend to see which ones are best suited for trading. The FX Calculators mobile app. This is for calculating what lot sizes your trades need to be in order to risk 1 to 2% per trade for your given stop loss size. Forex Factory and Investing.com mobile apps. This is what we use for the economic calendar to know what news events are scheduled which affect the markets. Forex Factory is the #1 website for this, but it doesn't have a mobile app. Instead, go to the Forex Factory website on your Safari on mobile. Hit the share button and then click Add to Home Screen. This will turn the Safari website URL into an app on your smartphone, and you can do that for any website on the Safari app on your mobile. So, handy little tip. Investing.com does actually have an app which you can just simply download, but Forex Factory is the #1 staple for the economic calendar. Telegram and Discord, these are social media apps to join our community trading groups. Your network is your net worth. It's important to have a supportive circle around you for your trading journey. Another metaphysical principle is that you become the people that you surround yourself with. So if you want to become a successful trader, you also need to surround yourself with successful traders. If you've made it this far, it goes to show that you are serious about improving your life through trading. The next step to take is to carry on your trading journey with all this knowledge in mind and continue onto the more intermediate sections. You can do this by joining our free community, and you can find the link for this in the description of this video. Inside there's plenty more resources for free that you can learn to accelerate your trading journey. And if you're interested, you can also join our VIP section for a small monthly subscription where you can join our VIP community and trade alongside our mentors, including myself. So let's not waste any more time. Click the link in the description of this video and I'll see you on the inside.